So we're almost ready to start. Welcome everybody who's coming in. This is Matt Gamser, CEO of the SME Finance Forum. Welcome to the webinar. We have many old friends here, new friends coming in. I encourage you to please open your chat room, which is the icon at the bottom right, and use the chat room to introduce yourself now, and at any point during the proceedings you can ask questions and make any comments you wish. And otherwise, I would encourage people who are in our audience to keep your microphones muted, and unless you're a speaker, keep your videos off. That will improve the quality of your transmission. So we're going to start in just 1 minute. I'm going to one more time put my introduction in the chat room just to show you how it's done, and encourage more of you to do that as the numbers keep increasing. Welcome, welcome to one and all. So we are going to start now. Good morning, good afternoon, good evening to one and all. This is Matt Gamser, CEO of the SME Finance Forum. I'm coming to you from cloudy Washington, D.C. this Wednesday morning, my time. It's a great pleasure to welcome you to this open webinar. We have a number of old friends. We have a number of members of the SME Finance Forum, but we may have some new friends. So let me start by just saying a few words about the SME Finance Forum. If we go to the next slide, Mohan, or Carla. The SME Finance Forum is a global network of financial industry institutions of many, many types. They are all united by their commitment to improving SME access to finance. Our network now includes more than 250 members and partners. They have headquarters in more than 70 countries, and they work in just about every country in the world. And it becomes harder every year to fit all those logos onto that slide, but we have some pretty clever communications people, and they always impress me with getting it in. Our members are learning from each other. If we go to the next slide, linking to new business and partnership opportunities, and they get to lead the industry voice in high-level dialogue with our founders, the G20, with other important bodies like APEC, OECD, the Basel institutions, and more. And so if your institution is not one of our members and you're interested in being a member, please contact us after the meeting. Before I hand over to our moderator for today, I just wanted to say a couple things, because this webinar that we are jointly hosting with UGRO Capital is about two topics that are of incredible importance, but they're not often treated well. You know, with SMEs and SME finance, there is always, and I hope you can mute your microphones if you're not speaking, the SME financing, the question is always, come on, can this really be done? Can it be done to scale? Can it be done viably? And I think you're gonna have that question answered with powerful yeses today. But that still leaves the second question, because a lot of work goes under the name of impact and impact investing. And as I said, a lot of what goes under the name of impact investing is often not investing at all. It's just giving money away and not keeping track of what comes back. Well, today you're going to be hearing about ways you can invest, and both you and your SME customer are going to do well. The money's going to come back, and it's going to be something that's going to be scalable. The second thing, though, is to be impact investing, one really has to know what the impact is. And unfortunately, in too much of those who claim this title, there's a lot of emphasis on that they're doing this work and that they're getting this much money out the door, but there isn't so much information on impact. And we're going to make a big correction to that today too, because you're going to hear not only about that this is investing, it can be done efficiently and effectively, but you're going to learn about the impact too in a market like India. So, and then we're going to hear how many different and interesting organizations are approaching this. So with that, let me turn over to your moderator for the rest of this hour, Shachindra Nath. He is the chairman and managing director of UGRO, and I'm going to let Shachin tell you more about how we're structuring the day, and also he will be introducing our other distinguished speakers. So Shachin, let me hand over to you. I'm going to mute my microphone, and I look forward to this webinar.
Thank you, Matt. Am I audible properly?
You are indeed. You are indeed. Please go ahead.
Thank you. Thank you, Matt.
Keep going, Shachin. We will get your presentation up momentarily.
Especially is an important subject. Let me give a brief background about who we are and why we are doing this in partnership with SME Finance Forum. UGRO was designed and created to build India's largest SME financing business. Our journey started in 2018 when we raised roughly around $120 million of equity capital from few global market equity investors. Post-raising capital, our business has faced the liquidity crisis in India coming through LFS and also the multiple other crises and ended by COVID crisis itself. In spite of that, our commitment and conviction about small business financing and their potential continues to grow with every passing day. And over this period of time, we have built a portfolio of roughly around $395 million. We have been able to grow our book more than 125% year on year. And, we have built a formidable distribution of 90 physical locations, roughly around 1,150 plus employees. And we have till date financed 20,000 plus MSME borrowers in India. We are at an exit run rate of $45 million of incremental financing every month, with a capacity of going above $100 million, I think so in next few quarters. And one of the key differentiating factor, which we like to discuss during this session as well, that we have evolved into a completely data tech company, and we talk about the data driving the impact financing. And how the impact financing in India, and how this is changing the landscape. We would like to showcase a little bit of work which UGRO as an SME financing business has done over a period of time. Because as a mainline lender, sometimes people generally believe that impact financing is prerogative or a work which is done by either only microfinance companies or very small entities. But how that can be done at a scale, we wanted to do a retrospective study on that, and for which we instituted recently an independent consulting firm which did our impact audit and came up with the findings of that. While these are the findings of how UGRO have been able to create impact financing in India, but more importantly, what it will showcase you, that the potential of how we can change the life of thousands and millions of people in a country like India, and that's the whole purpose. And this is a kind of a thought-provoking idea, which will be the basis of our conversation today with this exceptional. May I request those who are not in the panel, can they put themselves on the mute, please? Yeah, thank you. So as you all know that India's small businesses are engine of India's economic growth. And, at the core pillar of what we call the Atmanirbhar Bharat, which is, self-reliant India. And why it is said that, small businesses are one which will pillar the self-reliant India is because almost 30% of our GDP is contributed by these small businesses. In India, we call them MSME, which is micro, small, medium enterprises. There are roughly around 63 million MSMEs in India, empowering around 111 million people's employment. But 90% of India's MSME are still self-financed or financed through informal channels. And hence the need of credit for small businesses is, immense in a country like India. Other thing which is sometimes missed that, if you look at the multiple, SDG goals which we have, and, the impact financing world and different multilateral DFIs, impact financiers, and now mainline banks also track. MSME and small business has potential to create impact across multiple SDG goals. So, no poverty, so 111 million people employed, and the chain effect of that employment in, making people out of the poverty is humongous. Gender equality in India, roughly around 20% of small businesses are women-owned businesses. 30% of India's GDP and 40% of export are contributed by MSME, which means that provide decent living. 33% of India's SME output, manufacturing output is from SME. So manufacturing innovation is happening there. And the inequality between the urban and rural divide is getting covered because a large portion, roughly around 51% of India's small businesses is still in what we call the semi-urban and rural sector. If you go to the next slide, please. But, in spite of that, somehow it feels that this gap of credit is never going to get fulfilled. In last 6-7 years, since, we have been on this journey of building a credit platform for India's SME, the staggering gap continues to go, expand with every passing year. As per the current reported numbers, there is a $507 billion of financing gap for India's small business financing. Then roughly around 35% of, the MSMEs are, only coming from informal sector. 47% of SMEs get excluded from formal financing because of multiple reasons, whether it's they don't have formal income or they have limited operational history. And only 18% of India's MSME are addressed by the formal financial institutions, which is banks, non-banks, and others. And also what we have seen that there is a bias towards the medium-sized enterprises. 2/3 of total financing gap in India still comes from small enterprises. There is an inequality in the lender coverage, and the lending processes generally across the lending institution still is very outdated. Especially in market like India, and so is in other part of the world, it is still highly collateral dependent financing, and that is the biggest hurdle for providing credit to MSME, because every lender expects the small business to provide some form of a physical collateral, and COVID has not made life easy. The recent studies shows that almost 25% of MSME in India reported reduction in credit offered, supplies costs going up, and there is this 75% MSME has reported decline in their turnover and also the footfall in businesses. However, we are a very, young, nimble and emerging platform. But when we looked at of the $370 billion of financing, which we have done in last 2.5 years, the amount of impact which we could create was very sizable. So the way we actually constructed this study, which Satwa did for us, we looked at, MSME by customer archetype and as well as by the turnover types. We looked at the amount of loan disbursed, and we looked at the geography and the number of states. And basis that, we could see that on, different impact indicator, improvement in business and operation, employment generation, diversity, credit taking ability, and entrepreneurial ability. On all factors, there was a massive change which we could see post giving the credit from UGRO. If you go to the next slide. And this is some broad parameter. If you look at different SDG goals, we bifurcated our portfolio, and we saw that, we were able to finance food processing entities, we were able to do energy, we were able to actually support solid waste and scrap material, which is, clean energy. We did climate related cases, and it's not that it was done by design. By just naturally lending to small businesses, these kind of impact got created, including healthcare financing. For COVID-related infrastructure support, we created different program, and that has been very successful. And the quality of life, through our education portfolio has also been very serious. If you go to the next slide. And this is the real outcome which we have been able to measure. In terms of the outcomes, liquidity, what we saw that 73% of MSME financed by UGRO saw an increase of healthier cash balance on in their accounts, which impacted almost 13,000 plus, small businesses. So of the 20,000 plus, SME customer we have financed, 13,000 customers saw an increase in their cash balances. We saw almost 80% of our customer base who took credit from us saw an increase in the revenue side of their business, and almost 17% could expand geographically. So one store to two store, one small manufacturing to 5 small manufacturing units. Go to the next. And in terms of the second pillar, which is employment generation and diversity, we saw that, through a use of a multiplier impact, we saw almost 116,000 new employment getting generated out of the 20,000 plus SME customers. We saw almost 64,000 additional female employment happening. And we saw, estimated 172,000 daily wage workers within the small manufacturing unit got re-employment done within our base of customer. And we saw almost 7,900 plus, people's average wage or average pay getting increased post the credit disbursed from UGRO. We also saw, an average credit bureau score improving. So in spite of taking additional credit, there is a almost 2.2 percentile times of the credit bureau score increase. We saw the capacity to take more loan also increasing, and we saw almost 12% of our customer being the first time borrowers. And that obviously led to a very high degree of employment entrepreneurial confidence. And in our survey to our customers, 79% of customers said that they have more risk appetite because somebody was able to provide them the credit. So 13,000 plus customers had more risk-taking ability while they were coming out of the COVID, which is a very healthy sign. So that's, one of the reasons why we wanted to showcase this for the benefit of the audience and the panelists, that, an entity which is in existence for just 2 years or so, with, a very dedicated program for credit for SME, was able to provide this kind of, impact within the market ecosystem of India. But somehow, and as a practitioner and founder of a SME credit business in India, generally our belief is that SME financing and the impact world and the banking and financial institution, somehow it doesn't look to be the mainstay. Somehow the capital is getting channelized to multiple other things, but in a segment of the market which has such huge, obviously, credit challenge and as well as potential, is sometimes getting sidetracked. So obviously the IFC has brought an exceptional panel to talk about it. This group has brilliant experience, global and specific to India. So I would invite all of you for some of the opening thoughts. Centered around this, that India's relevant importance from your perspective, where you sit, and why why it is not center of attraction, if I may say so, and if it is, and what need to be done more. So we can start, and I would love to hear each of respective panelists to talk about their respective organization a little bit, and talk 5 minutes about the topic itself. Actually, Matt, I have lost you, so I'm not sure whether you have made an introduction to the panelists or not. If not,
Shachin, I was waiting on you to introduce your individual panelists, so please go ahead.
Okay, so we have this set of exceptional people. We have with us Deepa Hingorani, Vice President of IFU, the Danish Investment Fund for Developing Countries, and she leads the effort of debt and equity in this part of the world. We have Aditya Mohan, he is Senior Investment Manager of Tridos, which is also a specialist impact fund. We have Nikun Joly, who is Investment Specialist of Asian Development Bank. And we have, industry veteran Bama Balakrishnan, Chief Operating Officer of Northern Arc. which has supported and created multiple microfinance institutions in India. And she has been at the forefront of creating many other, uh, financing entities in India and providing both intermediation and balance sheet support. So I would start, Bama, from you, and then we'll go around to Deepa, Nikunj, and then Mail at the last and Sadit.
Thank you. Thanks, Shachin. Am I audible clearly?
Yes, you are.
Great, fantastic. Thanks, first of all, I think, for inviting us to be a part of this interesting and timely panel on how do we kind of look at accelerating the flow of capital to MSMEs, particularly impact capital, I think, in the current context. I did want to congratulate you, Shachin, and your team. I think it's a very insightful report that UGRO has been able to put out. When I was going through the report, I think a few things that kind of stood out for me, and I'll just talk about that before I get into more details. I think the first is the ability to kind of put out the end use of the loans. Having worked with a large number of financial institutions, one of the key challenges we see is that they are not in a position to kind of put out very clearly the end use in terms of the sector. They're very clear on what the purpose of financing is. But in terms of measuring the underlying sectors in a standardized manner, being able to map them, I think to the impact under the SDGs is, something which I did find quite useful. Second, I think some of the granular indicators, particularly, for example, in reducing gender disparity in employment, and which is actually, 2 degrees removed from the first level of impact in terms of extending the loan. I think that I thought was very interesting. Lastly, I think what I also found useful is measurement of indicators that go beyond the immediate impact and look at how do you kind of increase capacity at the MSME level for the future, which is, what you also highlighted in terms of the improved credit profile that the borrower actually acquires. And I think these definitely stood out when I kind of looked through the report. So congratulations on that. Very quickly, for the benefit of the, the wider group, Northern Arc was set up about a decade ago with a mission of facilitating access to finance for what we perceived as underserved and emerging customer segments. We work in about 6 sectors today. So apart from microfinance, the large segments for us are MSME financing, vehicle finance, consumer finance, as well as vehicle finance, agri, supply chain financing, and so on. We work with over about 250 financial institutions and platforms across the length and breadth of the country, and intermediate financing with over about 400 plus investors, both domestic and offshore. Interestingly, about 70 of our originator partners are all specialized MSME lenders. They offer a range of products to these customers, and I'll speak a little bit about that. Through these partners, we are able to reach over about 50 million end customers, and more than about 75% of them are women. But as you might guess, predominantly a lot of them are microfinance borrowers. So the proportion of women borrowers among the MSME borrowers still continues to be quite low. Since inception, we've raised about $13 billion for these partners across these sectors. About 20-25% of that financing is something that's flown through to underlying MSMEs. We've always believed, of course, in the direct and indirect impact of the financing that flows to the MSMEs as well. A few things that we've seen, I think, over this journey of a decade plus, we've seen the emergence of a large number of financial institutions that are offering products. The products range from term loans, which may be secured, unsecured, working capital lines, supply chain financing products, which are increasingly platform driven, machinery financing or equipment financing, as well as sector specific end use financing. So for instance, we have institutions which are specialized in financing school infrastructure and so on, or agri enterprise financing. Interestingly, of course, we've also seen the evolution of fintech delivery models in these sectors as well. So what are the things that have shaped our strategy here, which I'll sort of quickly cover? I think the first is the increasing digital footprint that MSMEs have in India. And this covers, increasing access to bank account information, tax returns, and even at the micro enterprise level. And anybody who's visited India is, I would say, pleasantly surprised after 2 years of COVID to see this, that even, small vendors are able to accept payments through the UPI network, and that again improves the data availability for debt underwriting. Second, I think, has been the increase, therefore, of digital collections that have come in. And post demonetization, I think the effort on digital delivery of credit and digital collections has improved significantly. Thirdly, I think the recognition of the importance of digital models in lending. So I would say that for a brief period between 2016 and 2020, pre-COVID, we did see the emergence of a lot of pure play fintech platforms. But I think what COVID kind of drove down quite clearly was the need for on-ground collections capability. And therefore, I think what we find today is that digital models, which combine the power of technology to reach customers and deliver products, and the ability to actually reach the customer and manage the portfolio, which I think we heard earlier about actually getting your money back, which is quite important if you're looking at sustainable sources of capital, is something that we've seen as key. I think the other big trend we've seen is the emergence of partnerships in a big way. So today what we see is that banks, who are basically the sources in a sense of deep, low-cost pools of capital, partnering with a number of financial institutions such as UGRO and others who actually reach the end customer, are able to then deliver credit more efficiently to the end customer, and partnerships have become a big part of the ecosystem. Two segments we feel are in a sense increasingly left out of the reach for finance. One, as I mentioned earlier, is women entrepreneurs. And while interestingly, I see more and more people focusing on this, measuring this, and reporting this. And there's a lot of work that I believe the DFIs have actually done over the last few years to improve this impact. We still see significant gaps there. Second, I believe rural MSMEs. So anybody who's not really in the immediate reach of partners who serve the urban ecosystem, I think are significantly left out. Also, a lot of the design of the digital platforms presumes literacy, it presumes an English-speaking borrower, and these continue to be limitations in a sense. But we believe clearly that there's a lot of effort that has happened as well. Thanks to the urgency of the pandemic. For instance, we've seen very specifically designed liquidity mechanisms, guarantee mechanisms coming in to support the flow of capital, including efforts which have been spearheaded by institutions such as SIDBI in India. And I think that has helped significantly, but it's important to sustain a lot of those efforts. So I'll pause there and perhaps come in for any questions that come in later. Thank you.
Nikunj, do you want to go next?
Sure. Thank you so much, Sachin. Hi, everyone. This is Nikunj Oli, and I'm representing the Asian Development Bank, more specifically, the financial institutions team under the private sector of Asian Development Bank. The ADB does have, a sovereign side that works mostly with government entities, with the sovereign, and then you have the private sector intervention. So in the private sector, we do have our interventions through financial institutions. We also work directly with corporates, more in segments such as agriculture, in education, in health, and then we work on the infrastructure side. So what has ADB been doing in India, especially on the private sector side, right? So India is our largest investment market, both on the sovereign side as well as on the private sector side. We have lending relationship with a number of large banks and NBFCs in India, and be it through debt or through equity. And beyond debt and equity, direct investments, what we've also done is we have a lot of interventions through indirect financing, most of it through guarantees. So one of the ways that we are addressing, the issue of providing financing to micro and small enterprises as well as microfinance is we work with partner financial institutions in India, which are mostly private sector banks, and we provide partial guarantee for their funding that they provide to MFIs in India. And so that's one intervention that we have. Currently, we have about 14 microfinance partners under this microfinance program where the funding is being channeled. One of the constraints that ADB has is in terms of resources, both financial as well as in terms of personnel, to do a large number of transactions in India. So we have to focus our interventions through a couple of entities, and most of them end up being, sorts of the larger to mid-sized banks and financial institutions. But recognizing this issue that, we cannot work with the smaller NBFCs who may have more targeted approach to financing SMEs. We are also in the process of designing an inclusive business program, and it's a regional program. It's not just confined to India, but India still remains a large part and focus of that program, where we'll again have these partner financial institutions who will identify based on parameters that ADB has assigned micro and small enterprises mostly that cater to the bottom of the pyramid and that cater to providing quality goods and services to underserved segments. So that's a program that we're working on, and we're very excited about it because this really encompasses the development impact and vision that ADB has on supporting SMEs, and where we may not be able to directly do this, we're relying on our partner financial institutions to have this deeper outreach to these, MSMEs. And beyond that, I would also like to add that, even when we're working with the larger banks or the larger NBFCs, our funding has very, very targeted use of proceeds. And most of the time for us, it's going to be, targeting that funding to underserved segments. Bama has already talked about, women entrepreneurs, rural finance. More often we are talking about the EWS, the economically weaker segments and the low income groups. We also work with the Indian government. Again, we're trying to channel more funding into the lagging states, right? It's actually quite helpful for us that there are some standardized definitions and taxonomy that the government has put in place where we also recognize that interventions are needed. So that way, I think India stands out among its peers in South Asia, where there is a lot of focus on government support for MSMEs. There are multiple schemes. I think the government is doing a great job of, updating the definitions for MSMEs as well, making it more inclusive, having multiple schemes in place, and then increasingly, the discussions around ESG, with SEBI taking the initiatives and putting this framework in place for the larger banks. We're hoping, it also trickles down to the smaller FIs as well, more on the NBFC side as well. And increasingly, I guess, green finance is another thing that's become more important. And then we are trying to work with banks and financial institutions to target our funding into small, medium enterprises that do work in renewable energy and climate finance and in the green finance space, right? And I think there are efforts being taken by the government to have sort of a standardized taxonomy or a public policy on this. So we're looking forward to that, and then looking forward to more interventions in India to support the SME segment. Thank you.
Thanks, Nikunj. That is some very promising word, but I would come back to you because I would still say dil mange more, our hearts ask for more. But I'll go to Deepa then.
Thank you, Shachin, and thanks to the SME Finance Forum and UGRO Capital for providing this opportunity for IFU to participate in this panel and share our views. I think for the benefit of those who may not know about IFU, I'll just take a minute or two to explain who we are. So IFU is DFI, which is owned by the Danish government, and it has been investing in emerging markets for the last 55 years. So today, IFU is managing its own capital, which it got originally from the Danish government. But in addition to that, it's also managing private capital, which it has raised from institutional investors in Scandinavia. So this pool of private and public capital is being invested by IFU predominantly in the form of equity across multiple sectors in developing countries. Our investment ticket sizes are usually in the range of $15 million upwards to about $50 million. So as a fund and a fund manager, I would say IFU is fully committed to making investments that create a positive impact. And basically, if you look at our investment strategy, it's resting on two key pillars. First one is investing in climate, which is basically investing in activities which are contributing to green transition, climate mitigation, adaptation. And the second pillar is just an inclusive economy, which is basically then investing in activities which are contributing to reduction of inequalities, including income inequalities. And that's basically where the MSME financing space, comes into the picture. So just come back to you, Shachin. We are not at IFU isolating this space at all. Quite on the contrary, I mean, as you also have, very well highlighted, the sector is a significant contributor to the GDP of most countries. I mean, India included. Roughly 30% of the GDP is being contributed by this sector. It's a great, employment generator and definitely something which is contributing to reduction of inequalities. And if you see that in parallel with the, the massive gap in financing that you pointed out, I hear numbers between 350 to today you mentioned 507. Whatever be the number, it is a very massive gap in access to financing that MSMEs have. So, there's no surprise that this investing in companies that are providing financing to MSMEs is something that fits very well into our investment strategy. And we are currently evaluating a couple of opportunities, investment opportunities in the space, including in India. I think it would be relevant also to mention that India as a country is in fact the single largest country with the maximum exposure that we have. As of today, it's about 9% of our asset under management that is deployed in India, and I would say that we see this number growing in the coming years. So to basically address your question, Sachin, I'll mention 3 points. The first one, I'll take the liberty of presenting my views as an equity investor. And there I would say there are many positives that India offers as an investment destination. There's no doubt, there's scale, there's growth. However, for an incoming equity investor, when you look at the risk return equation, it's quite challenging because if you look at, let's say, an entry valuation, basically the way to justify that entry valuation would be if you were to assume that over the next 8 to 10 years, which would typically be the hold period, for average hold period for an equity investor like us, you assuming an ideal scenario where you'll have a period of uninterrupted growth, where your NIMs will grow, where your operating costs will be, going down to the minimum, and your credit cost will also be going down. And basically, you will have only one thing growing, which is your return on equity. I'm not saying that that cannot happen, but I've been investing in India for more than 2 decades. I'm yet to come across a period of 8 to 10 years, where you will not have any interruptions. And that may not be due to any reasons connected with your investee, but basically, external factors which are beyond your control. So if you are faced with, let's say, opportunities where as an investor, you have to pass away your upside from an investment already upfront in the form of a high entry price, then you're faced with a situation that you given away your upside upfront, and then you have a lot of downside to face for the term of your investment. So I'm being very blunt and frank, but I think in this forum we can be. So I'm just saying this is really a key challenge. And I mean, yes, these are factors that you will face many other countries in the world, but you do see quite. I mean, we invest all over the world. We see this to be more prevalent in India than in other countries. So that's the first point I wanted to make. The second is more, from a general perspective, for the MSME financing ecosystem to develop, grow, and flourish in a sustainable manner, one will need to ensure a regular flow of capital. That's what also you were saying, and you need a lot of debt to come in, and of course, you also need equity to come in. And for this, we really need, the lenders and the equity investors to feel confident about the ability of the sector to deliver return on assets, yes, in financial terms, but also to do this consistently and in a responsible manner. And by that, I mean, that we need to see institutions as a community, build robust practices, starting from how you originate your transactions, what kind of practices policies and practices you have for your underwriting, how service-minded you are towards your client, and even, your collection practices, how acceptable they are in today's world. So I think and on top of that, what we need is an overall strong internal control framework and a very high governance standard right from the top to the bottom. And this is, there's a lot of good work that has been done within the microfinance space, I feel, over decades with collaboration between institutions, industry bodies, associations, and investors. And I think instead of like trying to invent the wheel all over again, I believe there are quite a few good points of inspiration one can take from that sector and apply them to this space as well. The last point that I want to mention is something that both you and Bama have already alluded to, which is on impact measurement. So today, investors and lenders in this space have progressed in their impact creation expectations. It's not like, okay, we are investing in the MSME space and that's impact enough. So we need more, right? And we need concrete indicators that can, by recording, measuring over time, can demonstrate concrete impact that has been created associated with the investment or the loans that have been provided. The good thing is that today companies like yourselves, are very well connected to your customers digitally. You have access to a lot of data. And while the primary use of that data may be, for measuring the financial performance, I mean, as you have demonstrated, in fact, the report that you just shared is a very good demonstration of the fact that this data can actually be used to measure, to identify, measure, record impact creation, which is something that gives a lot of confidence and creates the appetite amongst investors, to invest in this space. So that's what I had to share. Thank you.
Thanks, Deepa. Very encouraging words. Aditya, come to you. What's your initial thoughts?
Sure. Thanks so much for Sachin and the SME Forum for having me here. Yeah, it's a pleasure to interact and great to be together with all the panelists. And some of us we have met and some of us meeting digitally after a while. Yes, I think our a little bit of background about Triodos. Triodos is a private sector bank. We are a Dutch institution. The origins of the bank are purely oriented towards impact, and so it was sort of conceived and set up as an ethical bank in the Netherlands. I'm part of Triodos Investment Management, which is the asset management arm of Triodos Bank. We run multiple funds into which we have mostly private investors participating, and with each investment fund having its own theme. The most prominent among our emerging market funds are our financial inclusion funds, of which we have been quite active in India as well over the last decade and a half. India remains an extremely important market for us. Our funds are hybrid, so we do 70% of our fund. Our AUM is approximately in debt, and about 30-35% is in equity. So we are actively investing in India both on the debt and equity side. I think we are all, given the size and opportunities in India, we are always at our India limits. India is by far our largest exposure in emerging markets at Triodos. We're at close to 15% and intend to keep it that way and sort of grow our exposure in accordance with the direction our AUM takes. A little bit of then sort of moving from Triodos to our perspective or experience in the sector and where we are going. I think historically, microfinance has so far been the low-hanging fruit for all players in the ecosystem, right? So in India, you don't have banks looking to lend to these MFI clients. From an impact perspective, historically at least, until the last couple of years, you didn't have so much of, let's say, the public sector banks, etc., looking to lend to NBFC MFIs. So it worked well. So everyone had sort of a monopolistic kind of or unique niche in that sense in case of microfinance, where we are all playing in this sector where there's limited competition for customers on the liability side, etc., etc. So I think that was sort of easy. I think as we move to the MSME side, it's much more challenging because there are many more players who are operating in the same segment. I think on the liability side, you have some banks which are trying to address this market. Again, on the asset side, you have borrowers who have access to multiple sources of capital. So you are not a unique provider of capital to an MSME borrower, or unlikely to be a unique source of capital. So I think you have to differentiate yourself beyond saying that, hey, look, you don't have anywhere else to go to, so just take my money. So I think that transition in mindsets makes the MSME lending sector much more challenging and also interesting. And I think as a consequence of that, uh, given the evolution of both technology and regulation in India, we see increasing opportunities for collaboration. I think collaboration, one on the product side. So we have seen opportunities like co-lending frameworks being set up by the RBI, which not only, I mean, which provides MSME lenders perhaps like UGRO access to capital, but also reduces the cost of capital for the ultimate borrower, because you are co-lending with a bank whose cost of capital is significantly lower than your own balance sheet as an NBFC. So I think the increasing deployment of these structures to make the market more efficient is something we see as an important area going forward. The other aspect, I think, as a fund, a couple of impact areas that we see or we would like to focus on going forward remain renewables and also agriculture or food. I think, Sachin, I think it's some of in your report we saw some reflection of that, like food processing units and so on. I think this can be very impactful, at least from our experience. I think on the one hand, because you have these smallholder farmers with very limited sources of income and limited means to augment your income because of, I mean, limited waste for value addition, which I think that problem to a large extent can now be sort of addressed through technology. I think someone mentioned in the panel about micro payments and everything being digital. So I think the next step is sort of harnessing our digital infrastructure that we have in India to sort of make these impact sectors not just sort of a post facto outcome, but more consciously developing some of these portfolios. I think currently, if you look at digital frameworks, I think they're being largely limited to payments, and perhaps if you go to a tier 2, 3 town, the guy is probably using Facebook and then YouTube and perhaps a payments app, but not much beyond that. So to expand the use of digital beyond these 2, 3 use cases, and thereafter sort of build let's say food tech / ag tech, and perhaps some on the renewables. I think on the renewables there are a few additional plays like electric vehicles, e-rickshaws, etc., coming up. So I think using technology to expand these the impact sectors that we are looking to is an area we are looking to participate. And also secondly, structures or collaborative structures where with which we are able to reach or provide more efficient capital to the MSME segment is another segment that we are keen to sort of explore and sort of move forward. And so broadly, these are sort of our views, our experience of the market, and the direction we would like to take over the next couple of years in India.
Thank you so much, Aditya. And I think so, this panel brings that diversity. We have, a primary lender lending to SMEs. We have Northern Arc, who is a primary lender, also is a great, big intermediation facilitator of providing indirect credit to SMEs. We have ADB, who just said that India is their largest market, so is IFU. But Bama, somehow, this, and I may be wrong in my prognosis, it seems that SME lenders and financing of SME has become predominantly a job of only Indian banking system. majority of the multilateral DFIs, impact financiers, have moved away from broader categorization of SME financing, and we are competing either with other regions of the world, Africa and others, or we are competing to very niche things like which Aditya talked about, green, clean, other aspects. But the mainline SME financing and the availability of credit, especially both equity and predominantly debt, somehow when I talk to the world of impact financing, DFIs and multilateral, it is no longer a mainstay thing. Do you concur?
I would say broadly, yes, I agree with you. In a sense, it almost feels like it's been overtaken by other priorities at this time. But to be fair, I think, when we were engaging with a lot of impact investors and DFIs, I would say possibly just about when COVID started and in 2020 to a large extent, I heard a lot of sense of urgency about ensuring that there's access to finance for MSMEs. So I just wonder if it's possibly also the fact that to a large extent, at least overseas investors have not even been able to travel into the country, observe the credit environment on the ground, get a sense of what the ground realities are, and also get an updated sense of the credit quality in the sector. I think they are fully seized of the need, but I'm not quite sure how much information and first-hand perspective they have on what the credit environment of lending to MSMEs in India looks like. And to be fair, I think just as we saw the impact of the pandemic receding, we've got into other geopolitical issues, concerns around inflation, concerns around rising interest rates, and we do get a lot of questions on the combined impact of all of this on the MSME segment, especially the the smaller micro enterprises, micro enterprise borrowers. So I think perhaps there's a need for better communication. I do believe, like I said, that the intention is truly there. And I think the second challenge is, I think what Deepa spoke about, you and I both spoke about, which is how better do you really showcase the impact? And there's been, I think, that gap when we meet a lot of MSME lenders. To some extent, I think the gap in financing has been met by the directed lending benefits in the domestic market. But honestly, I think there is a lot more that can be done. But that's broadly, I think, my take. Because we continue to meet a lot of impact financiers, DFIs, who are very clear that enabling access to finance for MSMEs is important for them. But it just comes with a lot more by way of guardrails now.
Okay. Yeah, because one of the things you see, if you take the top 5 DFIs, IFC being one of them, CDC, some of them are actually only talking about either, things which are directed to, clean or green, some of that, but not broader SME financing per se, right? So that's why, sometimes, especially, for large lenders, that might still work because large lender may still be within their SME financing portfolio, may be able to identify targeted lending, but a smaller set of pure play SME financing NBFIs, it is very hard for them to attract that capital. And as you know, below a rating threshold of probably Indian banking sector also does not provide too much of support, and that's where the choking is happening right now. Okay,
Sachin, just one intervention from my side. I think we are also seeing some innovative, somewhat innovative products coming into the market, like social bonds. You yourself, as UGRO, have taken something from responsibility. I mean, do you see that some products like those could be grown, increased?
Yeah, definitely, Deepa. But what I was saying is that there was a point of time wherein microfinance, just as as one segment of the
category.
Category for attracting capital. SME financing is another category in itself, but we have to do too much of slice and dice to attract capital for that. And somehow, why that is happening is, is we are trying to demystify that. And, that's what we thought that for some of the audience and for us, it would be helpful to understand their perspective. But actually, now this time I will start with Aditya again. That as a impact financing institution and as a largely a debt provider, you have talked about that green is more important and others more important. What is that can be done by the MSME financing institution so that became the mainstay wherein just financing SME, which is taking so many people out of poverty, the employment, the entrepreneurship, and everything is happening there. That how can we attract your category of investors, which are also driven to some extent with financial return, but also impact creation simultaneously. So, is there something missing from lenders' side?
Yeah, I think, Sachin, in our experience, the biggest sort of, let's say, missing piece or the biggest question we end up asking is, I mean, like some of what you showed as like a post facto analysis, some of that in how you build your pipeline, right? So I think the question that we always say is, yes, we understand MSME, but at least from an impact perspective, the concern is that, look, MSME can be a very wide variety of activities, and how do we ensure that it is going to desirable sectors which have appropriate, let's say, standards of environment friendliness, non-pollution, or maintaining appropriate labor standards, and so on and so forth. A lot of times that becomes sort of an area of concern, right? So I mean, uh, we have, for example, seen some lenders who have a large exposure or a large focus on the metal sector. So I understand that they have a lot of positive impact with the small with a small, let's say, scrap trader of scrap metal trader. But our ESG team will say, oh yes, but how are they tracking effluent treatment, or how is waste disposal being treated in that? So I think that's some of the challenges that we see. And so I think, to demonstrate that there is a sufficiently large impact portfolio which the SME lender would be financing, and not as a post facto saying that we have already disbursed and this is our analysis, but this is how we construct a portfolio. I think that would be very reassuring, especially for impact lenders, because some of these matters, like let's say, involvement of child labor or inappropriate environment practices, can become reputational risks. So it's not so much risk reward ratio. So I think, especially if you are marketing yourself to investors as an impact player, and then there's a story comes out that you're financing something inappropriate, it becomes a challenge. So I think that's where foreign lenders are extremely careful. So if that can be demonstrated, and that can be shown to be completely in control, people would be much more comfortable. Another aspect is also the how attractive pricing can be, right? So I think in general, the concern, especially in the MSME space, can be adverse selection. So if someone is willing to pay 26% instead of 18% to a bank, there's perhaps something wrong in the business. If he or she has access to bank capital and is willing to pay 28%. So I think these are some sort of additional areas in which we would see comfort before entering into relationships with MSME lenders.
Okay. And Nikunj, I'll come back to you. I think so, because as an Asian Development Bank, which works very closely with the Indian government and regulator, do you see there is more to do with the public-private partnership, and especially the roles of institution like yours? I'll give you an example. Central Bank, which is the Reserve Bank of India, came within $7 billion of COVID-related infrastructure liquidity program for Indian banks, wherein banks can lend either directly for creation of healthcare infrastructure, or they could lend financial intermediaries, regulated NBFC, for providing loans for creation of more COVID related infrastructure. The offtake of that was very minimal, because banks are still very credit averse, and they were even not ready to lend to NBFCs to lend to healthcare. Had there been this program be supplemented by a, say, partial credit guarantee, wherein any liquidity availed by banks from RBI, and if that liquidity is used by an NBFC, and ADB would have given a partial credit guarantee on that, I can guarantee you the entire $7 billion would have got consumed. Indian banks, especially public sector banks, like to be supported by some form of a credit support. We have seen that in what we call partial credit guarantee scheme, emergency credit line. But does these kind of thoughts of, rather than just using pure balance sheet deployment, but to provide, support in timely fashion in creating structures like these, is something which is a point of discussion within your work?
That's a very difficult question, Sachin, to answer. More so because, there's only so much intervention that we can do at the government level, right? India is a very large country with lots of resources at its disposal, and an ADB may not even, be a drop in the bucket sometimes for the government, really. I mean, with IFC and ADB, I know there's been lots of discussions with the government around trying to do more in India, but mostly focused on the private sector side. I think there is less and less focus that's going to be on the sovereign or the public finance and public lending side. So, in the schemes that the government comes up with, we really do not have any sort of intervention. On the sovereign side, also we don't really, and on the private side, just we're not even really related to that. Most of the discussions that we have with the RBI or the DEA are around how to facilitate foreign investments into the country, and then what can be done better so we can attract more funding into the country, not just MDBs or DFI funding, but also private funding, right? So that sort of remains limited interventions at that point. Now, on the private side, as I already mentioned, our guarantee product, our partial credit guarantee product, is the uptake in the market is quite good, and Northern Arc Bama here also could attest to it. Northern Arc is also a partner financial institution there, and we've gotten very good response, and then our communication with the RBI on the program has also been very good. In fact, we've just gotten approval earlier this year to further expand the amount that's being dispersed under that program. So all of these are good interventions. And again, the inclusive business program is again another intervention. But I did want to address some of your question around DFIs, are they moving away from just pure play SME financing, right? I cannot speak on behalf of other DFIs or multilateral development banks, but at ADB, there's always the question of additionality. And then there's always the question around, are we displacing private capital? What is our additionality? How do we bring in private capital? And then one of our targets is always on co-financing, right? So in some of these sectors like microfinance, we do see that we've been successful, and the sector itself has been very successful in attracting a lot of private financing. Mutual funds are in there as well, especially with the larger ones. Of course, the rating is a requirement for the mutual funds, but still, we see a lot of private players in the market. On the SME side too, we've not sort of stepped away from pure play SMEs. We are still doing that. Maybe our interventions need to be more channeled through the medium and smaller size NBFCs, and then that's something that ADB is evolving towards, doing more through small and medium-sized NBFCs than we've done in the past, right? But again, when it comes to climate financing, we don't see a lot of lenders doing that in the market. And we bring concessional financing, technical assistance, different interventions to try and get more financial institutions to do this. And also, in a way to do some pilots and also showcase that, this can work in a country like India, and try to attract more private capital into this green financing space. I think now, I know, it's the buzzword now, but it is something that we're looking to do. And we do have a lot of blended finance and concessional financing that's available for that.
So Mac's video is on, which tells me that I think so we are nearing our closing time. I think that this discussion can go on and on. As I said, that somebody who's a lender, who see every day into our door the amount of credit which we can provide versus what we are being able to provide, there is always a gap. Obviously, it tells me that there is more can be done, but I understand that we also have to improve. I think that my key takeaway is that it is not that within the impact financing world, SME financing is not the mainstay. It continues to be an attractive piece. But what is important is that every lender should be able to measure the impact properly, create the outcomes very clearly, and money is being utilized for what it is being taken for. That should be demonstrated. Uh, we are trying to do that, and I'm sure that many other lenders, as supported by Northern Arc, would improve on those parameters. Generally, in India, we are less compliant on those aspects because we see, and it comes from microfinance background, just giving money to MSME is about impact, but measuring that properly, I think so, is the time today. Over to you, Matt, for any closing word. And obviously, Matt, I keep telling and complaining about it that SME Financing Forum, which is set up by IFC, India is less weighted in their scheme of things. So, it is the time for making India as more important for SME Financing Forum as well.
Well, absolutely, Shachin, Shachin, you and Nikunj and Aditya and Deepa and Bama have really shown us why we need to be paying more attention to India, both because of the size of the unserved and underserved market, but also because of the potential impact that SMEs play. I mean, I think you made exactly the right takeaway from this panel in saying that, look, the development finance institutions of this world are not going to retreat from SME financing, but to keep them in the biggest way possible, we have to be looking very specifically at what is the impact of financing SMEs on those sustainable development goals. There's, you go to the United Nations, they state very clearly the importance of SMEs with relation to many of the sustainable development goals. But that doesn't mean that we're off the hook. We have to be measuring. I can certainly tell you from IFC's board's point of view, just counting up the number of SMEs that the banks and non-banks we support finance is not enough for them. They want to know about jobs. They want to know about livelihoods. They want to know about essential goods and services. They want to know about key innovations and competitiveness and things like this that you were talking about in the very beginning in that impact presentation. And it's clear that we can do a lot there, but we've got to proceed in a way that makes sure that we capture. And India is one of those markets where, as several of you have said, because of the tremendous public investment in digital infrastructure for both financing and for, if you will, the Internet of Things. There is so much potential to use India as a real example for the world of what we can do and what we can measure. So thank you, panel. You've been terrific. I speak for the audience. That this was really, really informative. We could have gone on much longer, and we'll take this topic up again. Maybe we'll take it up again at the Global SME Finance Forum meeting, which is coming up in September 19th to 21st in Phnom Penh, Cambodia, where it won't just be about Southeast Asia, but it'll be about the whole world. And I hope many of you will be joining us there. We're making a 3-year return to having physical meetings, and having just been to my first physical meeting in 2.5 years, I can say that there really is a difference when you're at a physical meeting. These webinars are great and we learn so much, but we long for those times when we can, really be there in person and have those spontaneous encounters. And that's why our members voted to go physical again this year, and so that's what we're doing. So hopefully many of you will join us, members and non-members alike. I also want, for members of the SME Finance Forum, next week we have a community of practice meeting for our Women's Entrepreneurship Finance Community of Practice. If you haven't registered through the member portal, please do that. Sorry, I'm on the wrong slide. And we will have our virtual marketplace, which is open to all, on Wednesday, the 6th of July. So lots of events this month. If we go back, there's also the SME Finance Awards competition is still open. You may have seen some chat on that during this session. The deadline is the 30th of June, so you still have time, but you have to pull your finger out, as we say in English. If you want to apply for an award, there are 5 categories. There is special recognition to those working in challenging markets like the poorest countries and fragile and conflict-affected areas. There's a brand new category on best sustainable bond of the year. So if you're working in that area, great time to get in an application, because with the first year, maybe we won't get as many people trying their luck, and it might be your best chance. But once the award becomes better established, there are more competitors and it gets harder and harder. In addition, we have our G20 database. So awards are something where many will apply and few will win. With our database, everybody who submits a case study of innovative digital work you've done to help SMEs, especially those that are going beyond credit, you will get into this database, which we are creating with the G20 Indonesia presidency. This will be a permanent place where everyone can go, whether you're G20 finance minister, central bank governor, or just anyone that's on this webinar can go and find these case examples of innovative practices. And we are hoping to have many, many cases, and we have no limit to how many we can contain. So there's no absolute deadline on submitting a case. This is going to be a living database, but if you have some things you've written up already, please consider contributing them to the database. And the information on that can be found on our website. Okay, I think I've covered just about everything, even though I went through the slides in completely the wrong order. But just finally, to our members, it's great to have you here. If you're not a member, we'd love to talk to you about membership. We have about 250 members and partners in our network. Network effects get even stronger when you have more in the network. So I think we're much bigger and stronger than we were when we were 80 or so members in the first year, now that we're 250. And I think we could get even stronger with a few more members. So please do think about it if you're not a member, and we're happy to talk to you more about it. You can also just follow us on our various channels on LinkedIn, on Twitter, on Facebook, or just write to us at SMEFinanceForum@ifc.org. We will respond to everybody. If we had any, there were some great questions responded to in the chat room. If by any chance we missed your question, we're going to look through that chat. We're going to be sending it to the speakers, and we will try to get you responses, as well as writing a blog on this wonderful webinar that will help summarize it. And so if your friends missed it, tell them they can wait for the blog and they can have the recording later on the SME Finance Forum website. With that, let me say once more, good morning, good afternoon, and good evening to one and all. I want to thank again Shachin and our panelists, Nikunj, Deepa, Bama, Aditya. You've been really got us excited about India. We need to spend more time in India. With the G20 presidency moving to India this coming December, I have a feeling India is going to be fairly front and center in our thinking. It should have been all along. It's going to be there. And I look forward to spending much more time on what's happening in India. So thank you all. With that, I declare this webinar. Oh, and thank you finally to UGRO for conceiving of this webinar and for helping us design and deliver it. I hope you found it the really rewarding experience that we have. And for anybody interested in UGRO's work, just get in touch with Shachin and his team. They're happy to tell you more about what they're doing. So with that, let me declare this webinar closed, and I look forward to seeing you all again at future SME Finance Forum endeavors. So namaste, everybody. See you soon.